Just in today, the Bank of Canada cut their target rates by 25 basis points. This is the first cut of 2025, and so far, target rates have come down by 200 basis points from the peak, and right now we are sitting at 3%. Now, most people actually saw this coming, so the real question really is, what's next, given the US tariffs that can really shake things up? Well, let's break it down in this video, but before we do, please do us a quick favor, hit that like button, subscribe for more real estate investing tips, and if you want to chat one-on-one about your Toronto real estate investing plans, feel free to book a call with us. First, let's talk about the January 2025 Bank of Canada announcement. After today's cut, BOC says that they're going to shift towards a wait-and-see approach from here on. Inflation seems under control for now. Our economy is weak, but the biggest uncertainty does come from the US, and that's really going to keep things tricky moving forward. If we look for direction from economists elsewhere, they're actually pretty split. Bank of America believes that after today's cut, Canada will actually hit pause and rates will stay this way for the rest of the year. The big reason is that they don't expect US tariffs to actually kick in, and they think that Canada's economy is actually starting to recover since they're already seeing signs of this from our stronger December jobs report. On the other hand, Canadian economists do disagree with this, and a lot of them are actually expecting Bank of Canada to continue to cut rates at least a couple more times this year, bringing our target rate closer to 2.5% by the end of 2025 because our economy needs a lot more of a boost. But either way, these views get thrown out the window depending on the US tariff wildcard. The US has threatened to impose a 25% tariff on Canadian goods starting February 1st, and that could have a huge impact on our economy. According to an old Bank of Canada monetary policy report, a 25% tariff could actually result in a 6% hit to Canada's GDP. To put that into perspective, during recessions, GDP actually declines around 2 to 4%. So a 6% drop would be massive. And so if that happens, BOC might actually have to be forced to cut rates more aggressively to offset this damage. Now, our dollar is already weak. It's sitting at around 69 US cents for every dollar. If tariffs go through, it could fall even further to 64 cents, which would make everything even more expensive here in Canada, driving up our inflation again. And this is what makes things so tricky for the Bank of Canada. They're actually juggling three big issues all at once: controlling inflation, supporting our economy, and making sure the Canadian dollar doesn't take another big dive. On top of that, they're navigating the potential fallout from a trade war as well. And if Canada decides to retaliate with its own tariffs, then it could push inflation even higher, putting the Bank of Canada in an even tougher spot. It's a lot of things to think about, so let's bring things back to Toronto real estate for now. With fluctuating interest rates, the real estate market will likely stay soft here in Toronto, but overall, we do think that it is going to be more stable than it has been in the past few years. Fixed rates are sitting around 4%, and it's probably going to stay that way, and variable rates should drop closer to 4% in the coming future. So either way you look at it, rates will be around 4%, which will make it a lot more predictable compared to when rates were jumping between 3 to 6.5%, and this is going to help keep property values more stable too. And when it comes to rents, the lack of new immigration and a weaker economy could cause rents to fall further. Here's just some back of the napkin math. Each time variable rates get cut by 25 basis points, rents could actually fall by around 2.5%, and cash flows will stay pretty stable. So if we do end up getting 3 rate cuts of 25 basis points each in 2025, then we could see rents fall another 5 to 10% without actually hurting cash flows too much. And given this, here are just a few things that real estate investors should keep in mind for 2025. Number one, it is not the time to bet on property values. Number two, if you're investing in real estate, focus on assets that give you strong rents and cash flows like multiplexes, not condos or single family homes. And number three, If you're looking for better returns, take on value-add projects. Right now, all levels of government are making it easier for us to add more units to houses. Permit approvals are speeding up, development charges are getting waived, and there are more ways to finance construction when you're adding units to a home. And all of this does lower the cost of these projects, making the returns more attractive. And the best part is that you will have more control over these returns too. But if you're really not sure about what the best move is for you in terms of real estate in Toronto, let's just chat. We're more than a real estate sales team. We're experienced real estate investors in Toronto, especially when it comes down to multiplexes and value-add projects. Whether you're looking for a turnkey property to invest in or you're looking to convert a house into a multiplex, we've got the expertise to guide you through all of this. Here's what it's like to work with us. We'll take the time to understand your goals, crunch the numbers, and find you the best investment opportunities, and eventually help you land the right property for you. If you want to dive into renovations, we can connect you to trusted contractors and guide you through the process as you manage it yourself. But once the project is done, we can even handle leasing and property management too. Are you ready to get started? Just head over to this link here and let's chat.